prepared. Wasn't prepared for traveling and the likes when it came to keeping my mojo going in the mornings for our 8 o'clock Wealth Coffee Chats. But back in the office today and got my mojo on. Hopefully get myself organised properly today. Hopefully everyone's well. Hey, listen, hope you had a good weekend. Good to see the regulars on the return. Good morning, Alison. Thanks, Jeff. I hung out with the crew up in Brisbane, so that was kind of nice. Morning, James. Arnie, good morning. For those who are mentoring, tonight we're doing some fun stuff. We're launching one of the deals with Aria. You guys know these guys if you're mentoring. A lot of fun. We're going to do a bit of a television show, so make sure you tune in tonight for the mentoring launch. It's going to be a little bit of fun. Hey, good morning, Mark. Good morning, Andrew. Good to see you guys. Graham, how are you, mate? Good to see a few jumping on. Sineth, hey, good morning. So I hope you're all well. Welcome back, those who are coming back, like Jimmy. And anyone who's here who is new, g'day, welcome. Jason Whitten is my name. Been property investing over 20 years. Coaching property investors across Australia and New Zealand since 2003. It's close to 18 years or 18 odd years. So, along the way, done a few deals, helped a few people, and each morning on our Wealth Coffee Chat, we get to share a little bit of something, bit of ideas, bit of encouragement, bit of inspiration, bit of pontification, maybe some wisdom, and hopefully keep you guys going over the long term, because this thing is a marathon, not a sprint. Property investing takes time. Anyone who tells you the contrary is full of it. And the basics for me is that you buy something well and you never sell. Everything else springs from that, as far as I'm concerned, when building a property portfolio. But today I want to talk about going the distance and making sure you're not negative cash flow. If you want to be able to at least have some fun, at least to have less stress, less impact in your day-to-day life when it comes to building your property portfolio, you want your property portfolio to be positive cash flow and also positive funding. And it doesn't mean you have to buy a positive cash flow property per se from the rent. And I want to explain that today, because often we think, I want good cash flow. I need to go a long way away and buy a really high yielding property. But that has its own issues as far as I'm concerned. Your money is located then in a substandard location 9 times out of 10. But then you bring it back closer to, maybe a city or maybe a better location you think that's there, and then your cash flow is a challenge. So let's talk through that this morning, gang. Okay, so stay tuned. We're going to have a little yarn about, some of that sort of stuff. So just check this out right now. According to the ATO, the latest snippet I could find, I'm sure there's some newer stats, but, it's probably still translates into the world of property investors, is that around about, on average, 60% of property investors, hang on, I need to connect my pen. There we go. Well, this is not going to work if I don't have the ability to write. Looks like it's writing. Maybe I'm just not getting that thing. There we go. All right. It's doing something, gang. All right. So listen, around about 60% of the marketplace on average has an overall net rent loss. That's a fancy way of saying the negative cash flow. Money's coming out of their pocket, out of their daily income, okay? Out daily, out weekly, out fortnightly, out monthly, whatever that is, that's negative cash flow. So for me, We don't want to have that situation. For you, you don't want to have that situation draining you of income when it comes to your property in the world. Now, we want to be in this space, overall net rent neutral or profitable, positive cash flow in the coffers, in the pocket. So let's talk about what that looks like when it comes to you as a property investor right now, sitting there going, all right, well, how do I manage this? What are you talking about, Jason? All right, so let's have a bit of a look. So let's do a little bit of a timeline. And I just want to put a little bit of sort of perspective around what this might be when it comes to us building our property portfolio. Let's say you get your first investment property. Now, for me, like many of you guys know, I prefer you to buy something new, something that will rent well, something in a great location, located around a quality area, quality infrastructure, the quality of the tenant you can attract, et cetera, et cetera. We've talked about this before. So let's say, for example, you buy a nice property and let's just call it, $550,000. And I'm just going to round it up to $500,000, just for argument's sake. Okay. Now, if that property rents for around about $500 a week, if that's a house, that would probably be around about neutral cash flow. Okay, so not a lot of money in your pocket, but not a lot of money coming out. Okay, we could, and if anyone sitting here right now is going, what is he talking about? You guys should know this. There's a cash flow calculator that we have for all of our members, and you can download it off the Facebook group if you haven't already. And I've done a little training video on this as well. So I'm not going to dive deep into the analytics of the cash flow. You guys can go and muck around with that cash flow spreadsheet. What I'm going to do is talk about the strategy about what happens when you build your property portfolio. Now, we need to talk about a couple of things. Buffer. Okay, that's up the top there. Hopefully you can see that. Number one, buffer. And number two, your positive cash flow after tax. Where does it go? Okay. So for me and you, every single property you own should have a emergency buffer. Listen to me now. An emergency buffer on your property. From the day you own the property, you should have an emergency buffer on that property. Now, if it's a brand new property, it should be a minimum $5,000. Okay. If it's a secondhand old property, maybe $10,000. Secondhand properties, older properties, they tend to have more maintenance. They tend to break a bit more, with surprises for you. But a new property, $5,000. So let's say you've bought your property in your offset account, technically, or against that property. It'll be against your home, but gang, for illustration purposes, I'm putting it against this property. You've got your 5K buffer. This property is positive $500 a year, pre-tax. Okay. Hopefully everyone's following along. There's a lot of 500s there, a lot of fives there, but you get the point. So now that's not launching a rocket to the moon just yet, but the property is, give or take, taking care of itself. What happens? You guys should be doing this. You claim your tax deductions, your PAYG. Now you can do it weekly, fortnightly, or monthly, whatever your pay cycle is. And what will happen, most brand newish properties will produce, let's say for someone on $100,000, a pretty significant amount of tax deductions. You will get back between $4,000 and $5,000 of your tax in real cash back in cash flow. So as you claim the tax deduction, weekly, fortnightly, or monthly, those dollars go into your buffer. Okay, listening along. Now let's call it another 5K because 5's the number today. Now we're at year two. Year two, this property arrives at year two with $10,000 in its buffer from the $5,000. Year three, it has $15,000 and so on. And if you guys remember Sam's 10-year renovation plan, or think of that, when you arrive in 10 years' time, you will have 10 times 5, you'll have $50,000 in, hang on. You'll have $50,000 in your buffer. What would you do with the money in your buffer, gang? Times 10 years. You can renovate the property, fix the property up, etc. Okay? So, hopefully that made sense. Every year, you park your extra cash flow in that account, or account for it against that property. For those of you who understand what we're talking about here, that would be in your owner-occupier redraw facility or offset account. You still account for it wherever in your world, maybe a spreadsheet, maybe with your accountant, whatever it is. But you have a building buffer, a property buffer that is there for emergencies and also there for the renovation in the future. Because when you get to year 10 or year 12 or year 15 and you go, oh, how do I fix the property up because I want to freshen it up for its next run, it's keep current with the rental market, that's how you do it. Not a cent out of your pocket, gang. Zero, zip, blah, nothing, okay? Now, for me, I think that's fantastic. For many of you guys, if you want to think about it as you go along, here's some ideas. As you go, do your budget, do your numbers, okay? In 10 years' time, if you want to arrive with, 40K in the bank instead of 50, or maybe each year, from the depreciation and out of your cash flow, which is a tax deduction you get back from the ATO, maybe $1,000 from each property, okay, that you get back in tax, not from the rent, from the tax deduction back. Maybe $1,000 from each property is what you use for Christmas time for an extra little bit of fun at Christmas time. If you had 4 properties, that'd be $4,000 at Christmas time that you could use to do something fun with. Would that be pretty good? I reckon it would. Remember, gang, don't consume non-renewable income or capital. Okay, you don't consume the capital if you can consume or use the income that just comes every day, every week, every fortnight, every month when it comes to your properties. Okay. Anyway, lots of scribbles, fair bit of talking. Hopefully it landed or made sense. As you set your property up, a 5K buffer to begin with, all of your positive cash flow after tax goes into the buffer. Over time, you park that and into the future, you could use that for the reno in 10 years' time. It is there for emergencies and maybe a little Christmas bonus. Maybe it's $500. Maybe it's $1,000. You decide what you want that to look like, team, because reno in 10 years, emergencies, whatever. Okay. So there you go. Hopefully that made sense. Let me know in the chat if it landed for you, because we never want to be negative cash flow when it comes to our property portfolio. And if you run it like a business, if you run it like, all right, where's my capital? It needs to pay for itself. It needs to take care of things. What is it doing? That's a great way to do it. Seed it with $5,000 to begin with, and with a new property, 99% of the time, that will continue to fill those coffers, fill those buffers until you get to a point where you want to use it, or you get to a point where it's like, wow, that's a lot of buffer in there, and that property's going strong. It doesn't need a reno. Boom, away you go. Allison's in. She wants to join the 1% club. We're on it, Allison. We're actually going to do this. You guys are going to get a sneak preview of this. We've got some get-togethers, socials for the mentoring crew, the mentoring team, the mentoring clients. We're going to do some socials. Now we're kind of okay, touch wood, just to travel internally and book a few events we're looking forward to catching up with you guys. And we want to start to do, Alison, the 1% Club Awards for all of us as a bit of fun. So look forward to that. Anyway, gang, that's it from me. I'm done and dusted. Wealth Coffee Chat back on the bandwagon tonight. Gang, if you haven't already registered, get yourself sorted for tonight. And the mentoring night tonight, we're going to have a lot of fun. We're launching an amazing property deal, and we're going to hang out with some super cool people. And hopefully you can zoom in wherever you are and be part of it. So that would be awesome. Anyway, gang, that's it. Wealth Coffee Chat done and dusted. Thanks, Preet. Great to have you here. Excellent, mate. And hopefully get a chance to pop on back. Each day we do this around about 8 o'clock each morning. Each morning we do it, Monday to Fridays. And we just share 5, 10, 15 minutes of something that's going on because, like I said at the beginning, this thing's a marathon, not a sprint. Takes time to get it done and do it well. And, it's nice to do it in a crew. All right, that's it. I'm done. I'm rabbiting on now. You guys are awesome. See you tonight, whoever's coming. And, have a great day. See you tomorrow. Bye, gang.